me away. I wish you could take me away, but nothing will happen today. Baby, I just want you to stay.
Hello, everyone. Hello again. Hello once again. And hopefully you guys can hear me. Can everybody hear me? Can you just put a comment section if let's say I'm soft or anything like that? Just let me know. Great, great. Thanks so much, CH. Great. Okay. Hello, everyone. And okay, so far we have 32 participants. Thank you so much, Jacqueline. Thanks for the participation. Thanks, Dr. Lee. Thank you. Okay, it's me once again, Joe. Okay, so let's just give me some time to wait for a few more participants. So maybe probably 2 to 3 more minutes. All right, for everyone to come in, and then we can start lah. Okay, just a quick one lah. Okay, for those of you who don't know me, actually I do webinars uh most of the time monthly. Okay, I'm from the CFD team in Philip Poems. All right. So just for benefit of doubt, if you all do not know what Poems is actually a broker. All right, we are one of the first brokers that provided online trading, okay, into Singapore. Okay, we are one of the bigger brokers apart from all the other the traditional ones like the banks, okay, all the UOBs and the DBS, okay. So we are one of the earlier brokers as well. So for those of you who okay have not uh open an account with us. All right. I believe some of you here have not opened an account. I'd just like to share a quick one, okay, before we start and before everyone comes in. Of course, firstly, thank you guys. I really thank you guys for coming in to join this webinar on a rainy evening. Okay, I hope that you guys have a good dinner, enjoy yourself. Okay, while watching this webinar. All right. Hopefully don't fall asleep because I know it's raining. Sometimes you eat food already, you get like those like sleepy sort of symptoms. Like So I will try to make it as interactive as possible. Okay. But rest assured, all right, this webinar is really informative. It's helped me out in terms of investing, especially for those of you who have not went into investing before. Okay, it will be very useful. All right, what I'll be sharing. Okay, for you to actually hopefully make average returns from the market, make decent sized returns from the market. Okay, so again, okay, for those of you who have not opened accounts, we actually provide stock coupons. Okay, as a welcome gift for new poems new account openings. All right. And on top of that, okay, other than this welcome bonus, okay, I just like to share with you as well. You also can enjoy zero commission, zero US commission for 30 days. All right. And also enjoy free live pricing on SGX market depth. So some of you who actually want to use the market depth function as a new user, you can get all these goodies free as well on top of the stock coupon. So you can take a look here about the stock coupons. There's one that you can fund at least 3,000 within 14 days. You get times five $10 stock coupons, which you can use to buy shares. Okay. And then the other one is actually $150 worth of stock coupons, $30 worth of stock coupons. All right, times five. Okay, if you fund at least 10,000. Okay, and you hold the minimum of 30 days lah. All right, to get this amount worth of stock coupon, US stock coupons. All right, and here I will also share with you the link for the account opening. So while waiting, you guys can just for those of you who are interested to open an account with us, please feel free to do so. It's quite easy. Just sign up with your SingPass. We have two types of accounts. One is the cash plus and one is the cash management. Okay, the cash management account that we have these two are our flagship accounts. Okay, the cash management account that we have, it has of course a little bit higher commissions. You have the minimum $25 and then 0.28% for the Singapore market. Okay, why is because this account type is actually for mainly to your shares will be actually held or custodized under CDP. All right. So, but for the other type, which is the cash plus, okay, the commissions are very low. Okay, 0.08%. It's a marginable account. And your shares will be custodized likewise, not in CDP, but in with us, with Philip. That's why it's cheaper. All right. For those of you guys who want to actually ask questions, feel free to do so. Put it up in the comment sections below, in the chat section. Okay. Then I'll take a look at it. All right. Yeah. Great. You can actually put up your questions here, lah. Okay. And then I'll try my best to actually answer them. Okay. Okay. So without further ado, okay, great. There's already 40 packs coming in. Okay. Let me see. Okay. So once again, thanks for joining. Thanks everyone for joining. I will start my webinar proper now. Okay. So what we're going to talk about today. Okay. Before this, okay, let's do an introduction so that you all don't fall asleep, and then hopefully you guys can also interact with me. Okay, then I won't feel so bored as well. All right. And thanks for your support, and thanks you guys for actually coming down on a Thursday evening, all right, to listen to my webinar. I can assure you it will be very useful because this framework, I've used it myself and it's actually greatly helped me out in terms of investing, okay, in ETFs. All right, so here, let's do a quick one. Okay, how many of you guys here are new to investing? New, you haven't done any investing before? Yeah, okay. If you have no experience, you just put N, all right? And if you have experience, you just put yes. If you've done investing before, you dabble in the stock market before, put Y. So those of you who have not, put N, and those of you who have, put a Y. Come on, let's see how many of you guys here, so I can gauge actually my audience today. Oh, okay, great. Thanks, Jacqueline. Thanks, Chai Ho. Wow, most of you here are experienced. Okay. Oh, definitely no. Any more no's? Oh, okay. Great. Okay, I'll try to answer a few quick questions. Okay, Ming Chue said, said how rich to be an accredited investor. Okay, accredited must be 1 million. Okay, in terms of for the net financial assets. If not, you need to have a property that is at least worth 2 million plus your other financial assets. Okay, so you need to declare that. And another question here, okay, that you said, how safe is it to put our share in POEMS than to put in? Actually, both of them are safe because for us, POEMS, we are already quite established. All right. And then to put in CDP, of course, CDP is run by SGX, and you should know they are also very established. Okay, so both ways also safe. Okay, trust me on this because POEMS, we have been around for the longest time. Okay, right. Okay, so I believe here many of you actually are experienced. So good. Okay. What I'd like to share with you today is about ETF. So a lot of actually my clients ask me, they are not sure, they say, if what is good to invest in the Singapore market. I've experienced a lot of these questions before, especially to new investors and sometimes even experienced investors. So ETFs is a good way, okay, to invest. Okay, why? Okay, so here today I'll share with you why, the whys, and what are the ETFs, what ETF structures, how is ETF created? So you get a better feel and understanding of what ETFs are really made of. Okay, so that you can start looking into it. And I can guarantee you, okay, ETFs is a very, very good way and a very low effort way to actually start your investing journey. All right. So without further ado, let's go. Okay, this before we start, okay, this information, okay, it's just for education purposes only. I will not actually do a buy or call sell. All right, I will still give you some opinions, not opinions, okay, some information on what ETFs to look for, okay, but I will not actually pull a call on it. All right, so but feel free to actually ask me any questions regarding the ETFs later on. All right, I'll try my best to answer them. Okay, so for those who actually do not know what ETFs are, so what is an ETF? Okay, an ETF or exchange traded fund is a type of investment that pools money from many investors, okay, to buy a collection of assets like stocks, bonds, or commodities. These funds are traded on the stock exchange throughout the day, just like individual stocks, which offers flexibility and real-time pricing. Okay, this is the key here, real-time pricing. Okay, ETFs are a popular way to achieve diversification with a single purchase and often have lower costs than traditional mutual funds. So, okay, here, have you invested in ETFs before? Can you just give me a show of hands again? How many of you have actually invested in ETFs before? Yes, you can just put a yes, and then no, you can just put N lah. Okay, show me. Yeah. Dr. Lee, yes. Oh, good. Many people know. Awesome. Then this is a good place to actually start. All right. Okay, it's a good place to actually listen to me share with you what I have to say. Okay. So, for those of you who haven't invested before, okay, this I would like to share with you that. Okay, I'll give you a brief history first of what ETFs really are. Okay, so exchange traded funds debuted in 1993. So it's not a new thing, not a new thing. Okay, it debuted in 1993 and became the predecessor of the traditional mutual fund. Recall the days of the mutual fund, which means unit trust. Okay, previously when you go to a bank, the bank always ask you to buy unit trust. Okay, this type of unit trust, usually they will say, oh, they'll show you got growth fund, whatever, a moderate fund. Then when you start investing in it, you want to sell the time, you take some time, and then you don't know the pricing at all. Okay, and always, okay, remember, even until today, there are still unit trusts around. Okay, there are still people selling it. Okay, the banks are still selling it. All right, even though now you might still get it, you might get it cheaper because they don't charge as much sales fees on it, but take note that unit trusts traditionally have more management fees. The management fees are costlier, and you will not know the pricing. Okay, you will know the pricing later at a later stage. Okay, so when you sell, you will not know what price you sold at. Okay, that is the disadvantage of the mutual fund. So this ETFs actually became the predecessor of that. Okay, marking a major shift in how investors could access into the markets. Okay, the first ETFs drew their portfolios from shares in the big indices, okay, in the indices like S&P 500. Okay, and of course they started off with dealing with indices one. All right, like the S&P, the Dow Jones, all this. And after a major shift in the early to mid 2000s when the tech boom came up, all right, exchange traded funds now could hold bonds, commodities, currencies, invest products, real estate investments, and volatility assets. So this is why I'm here today, okay, to share with you guys the different type of ETF. It's not so simple as you think that ETFs is traditionally safer, so you can buy any ETF, it'll be safe. Okay, not true. So now, because there's so many types, so many varieties of ETFs, here I'm here to actually share with you how to look at it. Okay, how to look at it, how to actually break it down in a simple format and make you understand easier so that you can actually screen your ETFs quicker and identify the ones that you want to invest in. All right. So ETFs are often promoted as cheaper than better than mutual funds, like I said just now. Okay, due to their nature being listed on the exchange, and ETFs are offer low cost because offer low cost diversification, easy trading because you can trade over the exchange, and it's great for passive investing. All right, for most people who like to actually do not want to spend so much time in buying them. Okay, to further elaborate, ETFs can be classified into categorized into asset class, but management style and strategy as well. Okay, including equity and bond ETFs. Okay, other types of ETFs include commodities such as precious metals or oil, and of course, indices, which mirrors a specific market index, and also active managed theme funds. Okay, that sought to outperform an index, and also invest and leverage ETFs, which use derivatives to amplify gains or bet against the market. So ETFs also can be a good way to actually bet against the market. Means you can actually short. Okay, you can just buy the ETF that shorts the market. All right, so it's of course a cheaper way and it's less troubles, less hassle, because sometimes you need to do a traditional shorting. You need to actually borrow shares and stuff like that. But using the ETF, you can, if you think the market is actually bearish, you can just straight away go to an ETF that actually shorts the market. Then you just buy that ETF. All right. So each ETF, of course, caters to an investor's or trader's specific requirement. Okay, which ETF really suits you best depends on your risk appetite at the end of the day. All right. So just to share with you, there are approximately 12,400 ETFs available worldwide now. You see, so much, All right, how actually do you bring it down to those that you actually want to invest in? Okay, so big the universe nowadays. Okay, with more than 4,300 in the United States alone now. Okay, the market is growing rapidly with new ETFs being launched and across various asset classes and sectors to meet investors' demand. Okay, so Here, is it true that ETFs are safer than stock picking? This is what I want to share with you also later on in this webinar itself. All right. So investing in exchange traded funds is generally considered to be safer than stock picking, primarily due to the inherent diversification that ETFs usually offer. This diversification usually reduces the impact of a single company's poor performance. However, like I said again, it's important to remember that ETF investing still carries some level of risk, as the value of ETFs can still fluctuate with market conditions. Okay, before investing, you will still need to do your due diligence about the fund and how the fund actually operates. Okay, some ETFs use derivatives and debt to amplify daily returns. For example, the 2 times or 3 times leverage ETFs of another underlying index. So you see, index ETFs also, they have leverage 2 times, 3 times. All right, so you must be very careful you need to know, okay, what your risk appetite is before identifying an ETF to invest in. So not all the ETFs are safe ETFs, okay, because some of them they use these things called debt to amplify their returns. Okay, while some ETFs track an index on a one-to-one basis without using debt, okay. So of course, leverage ETFs are riskier due to the magnified gains and losses that are typically used for short-term trading, whereas the non-leveraged ETFs are generally considered safer and are more suitable for long-term investments. So how many of you who have invested in ETFs, like just I see many of you raise out your hands when you said you bought ETFs before. How many of you now actually have tried to use leverage ETFs? For those who have, show me a Y. Of course, those who say no, show me an N lah. Have any of you guys actually tried before any leverage ETFs? Good, good. Okay, so here all of us like me, I'm also very conservative. Yes, you can check. So you can actually see. Later I'll show you as well. How to screen the ETFs. I have a tool. I mean a site. Okay, that you can use to screen the ETFs. Yes, thanks Anne. Thanks Anne. Okay. For this question. Good question. All right. So how do we actually know? Okay, ETFs are actually leveraged or not? You can actually see it from their investment objectives, which I will share with you later. How I use this framework to screen, and also a tool, a website that you can use, okay, to screen to look through your ETFs. So be very careful, like I said again, when you start investing in any ETFs, because some of them, because it's leveraged, your losses is magnified because of when they price it, you will see in the price. Okay, you when the market moves, it moves 2 times, 3 times from the investments or the portfolio that they track. Okay, so I'll show you later how do you screen. All right. Okay, so moving on. Okay, here, okay, is a due diligence framework, okay, of how I actually screen my ETFs. This is a 5-step framework that I've used myself, all right, to do a due diligence. So a lot of people actually feel that, wow, investing very troublesome. Okay, need to do so much homework. I also don't know where to start. Okay, so this is a very good place for you to start by having your own framework. Okay, having your own framework actually breaks it down to make it simpler, much simpler for you guys. Okay, so here I can give you my own. Okay, you can also develop your own, no problem. All right, to actually identify a checklist for you to screen a particular ETF. Okay, so like I said earlier, I'm actually more of a long-term investor. I don't usually dabble into leverage ETFs myself. Okay, so my first rule is I'm a long-term investor. So I will share my framework based on this. Okay, if any of you guys are the same as me, long-term investing, okay, you take the long-term investing approach because you want to retire. And number two, okay, you also are risk averse. Okay, I mean, not say really risk averse. Okay, you are like moderately averse into actually dabbling because you got no time to actually look at particular stocks or look at the market news. Then ETFs is a good choice for you lah. Okay, just you have to choose the right one. Okay, let's start with the first. So the first one, okay, is the investment objectives. So I will need to take a look okay, what the investment objectives are for ETF. Okay, so most ETFs have a main theme okay, of what their investment objectives are. For index ETFs, for example, okay, they are designed to track indices. Very simple, okay. So understanding the index that the chosen ETF tracks is important. Okay, ETFs come in many types of flavors, and an ETF performance follows an index or sector very closely. Okay, like the Swiss Index, for example, or the S&P 500 index. Okay, these ETFs track the index. Simple as that. Okay. Also, different indices select their holdings using different rules as well. So not all indices are the same. Okay, you need to understand also which index, how the index actually pick their funds. Okay. So since indices differ significantly in terms of investment type and strategy, understanding the index construction methodology is also important in helping investors differentiate among the many indices in the marketplace. Okay, therefore, you will need to be clear of your investment objectives and be comfortable with what the fund manager will be investing in. Are you firstly more risk averse or risk seeking? Are you investing using long-term or short-term approach? Okay, these questions you will need to actually ask before screening for an ETF. So identify your own objectives first. Then go into looking at the ETFs that suits your objectives. Okay, that means the fund manager's objectives must also align with your objectives. Okay, simple as that. Okay, here. Okay, I'll put down the link of this ETF screener. Okay, it's actually the Poems ETF screener, and okay, let me tell you, this is actually very, very user friendly. Number one, okay. Number two, it's also very useful. Okay, these two I've used, very useful. Okay, for you to actually screen out the ETF because it's very informative. So I urge you, and it's free. Okay, I urge you to use this ETF screener from Poems. Okay, so you can find out the objectives of each ETF by visiting the link I sent to you. Okay, you can just play with it to screen for your desired ETF. Okay, using the Poems ETF screener. Okay, like here you can actually search by the various ETF categories. So like here on top, I said you can see the categories here, by exchange, by asset class, by country and region. You can screen through there. All right. So once you do that, okay, you click into an ETF that you want. All right. Once you actually identify the category that you are looking for, okay, here, the asset class or the exchange or the sector or whatever, when you click into the ETF, after you screen them, all right, you can, once you click it, you can see, okay, that the main page shows the ETF objective. Like here, for the Vanguard Total Stock Market ETF, for example, you can see the investment objective here, okay? It seeks to track the performance of the CRSP US Total Market Index, okay? Then it measures the return and so on and so forth. Okay, so you can see the objectives from here. And here it will tell you already whether it's leverage or not. All right. Okay, you can also go to its portfolio. Okay. The portfolio is on the right, the most extreme right. Okay. This is very important because you can identify the top 10 holdings the fund currently invests in. Okay. So this portfolio composition is also depicted in the pie chart, which for easy visualization. So here it will actually show you, okay, the structure itself of the construction itself, how they actually construct their portfolios, whether you are comfortable with the assets they are holding or not. For example, top 10 holdings, okay, you can see Nvidia Corp. All these are actually the Magnificent Seven sort of technology stocks in the US, the largest technology stocks. Then how many percent they hold in each of them? All right. You can also see from here, from the screener. So really, okay, save this down, save the ETF link, this screener down, because it will help you greatly using this framework that I'm going to share with you. Okay. So there are also many other things that you can screen using this ETF screener, such as the funds expenses ratio, which is also very important. Okay, the fund expense ratio, like I want to share with you again, okay, plays a big part in terms of, for me, at least, okay, in terms of investing in which ETF I want to go in. Okay, they may be the same, okay. For example, okay, I'm sure you guys heard of the SPDR, okay, S&P 500 ETF, and the VOO. Both of them track the same index, but both of them have different expense ratio. Okay, so expense ratio play an important part. For me, I of course, like, since we're talking about this now, I prefer the VOO if you are talking about the S&P 500, because the VOO charges much lesser in terms of expense, in terms of their costs. They are much lower. So because of that, the pricing is much tighter. Okay, so you can get more returns from it. So this plays an important part, the cost. So always take a look at it. Make sure you know the cost, compare it with the other ETFs you actually are trying to actually use. Okay, always go for the lower, the cheaper ones. That's at least for me. Okay, so you can explore this website, and you can definitely get a lot of value out of it. Okay, what's the next step? So the first one, like I said, okay, we supposed to look at the objective of the ETF, identify the objectives first. Then next one is the identify the ETF structure. Okay, so there are different ways of actually structuring an ETF, index ETF, to achieve the investment objective of a fund. Okay, the two most common one for index ETF is physical replication and synthetic replication. Most index ETFs use either these two. Okay, one is the physical replication and the other one is the synthetic. So what's the difference? Physical replication gains exposure to the performance of the underlying index by holding all, also called full replication or a portion, typically known as an optimized or stratified replication of the underlying assets. While synthetic replication, on the other hand, gains exposure to the performance of the underlying index through swap agreements. So if you see these are swap agreements already, this one is actually derivative already. Okay, so because of this, why should I care? Why should I care about an ETF structure? Okay, it's very important. Why? Okay, because as part of the ETF selection process, it is important to understand the differences. Okay, whether it's synthetic or physical, because this can impact the cost and the performance and the risk profile as well of the ETF itself. Okay, so this is what I want to share with you. That is also very important when you actually look at the frame. I mean, create this part of the requirement. Okay, for you to screen an ETF, understand whether it's physical or synthetic before you invest in. Okay, I always go for physical lah. Okay, because like I said, I'm more conservative. I will go for the physical one. Easy. Okay, easy for me to understand the structure of the ETF. Tracks it a little bit more accurately lah. Okay. So physical replication tend to be more transparent, okay, and easier to understand. That's why I prefer the physical. But okay, it can limit access to certain markets and exposures. Okay, so because it tracks it so well, you at most get the average return. All right. While synthetic replication enables access to markets and exposures that physical replication may not. Okay, so the downside of synthetic replication is that investors, of course, may be exposed to the counterparty risk because of the swap agreement. Okay, the website I introduced you earlier, okay, will show you the various ETF structures we have shared. Okay, it will show you on the main overview page. Okay, so let's move on. All right, to the third step. Okay, third step also very important. All right, which is called the implication on taxes. Okay, the taxation on ETF investments may arise in three levels. Okay, so what are the three levels? Okay, the investment level, ETF level, and treaty level. This is also very important. Okay, at the investor level, shareholders may be subject to taxation on income and capital gains. So investor taxation depends on the investor's personal circumstances in their where you live, okay, in your home jurisdiction. So withholding tax mainly arises in the country where the underlying equity or fixed income investments are domiciled. Okay, the tax rate partly depends on the treaty between the countries where the underlying securities are domiciled and the country in which the ETF is also domiciled. So there can be a case of withholding tax at 2 out of 3 levels of taxation described above. Okay, so when the ETF receive income or gains from the underlying investments, there can be local withholding taxes in the jurisdiction in which the underlying investments is situated. So the next one is the ETF level. Okay, so when the ETF actually makes a distribution to the investor, like I said just now, okay, there can be withholding tax, okay, in the ETF's country of domicile. So finally, okay, the treaty level one, okay, this is important for us, okay, because investors who qualify, a lot of actually customers ask me this as well, okay, so investors who qualify for the 15%, for example, withholding tax, 15% US withholding tax with onshore tax-paying investors, okay, in many European and Asian countries who have provided the W8 band. I'm sure you all know what W8 band form is, okay, and non-treaty. So Singapore is part of the non-treaty, okay, where investors will be paying the full 30% withholding tax rate, including offshore investors and onshore investors from non-treaty countries like Singapore. And investors not providing the W8 band, okay, also part of it. Okay, to find out more about taxes, of course, it will be better that you can speak to a tax professional at your base country of residence. So for me, you have to be aware, because based on my experience, when I invested in the US ETFs, okay, the ETFs in the US itself, in the US stock exchange, any dividends paid out, they'll take off 30% from me, because I'm a Singapore-based resident and I filled up the W8 band. Okay, so this you have to bear that in mind also, because sometimes you need to consider your dividend yield as well. How much dividend are you getting out when investing in a foreign ETF? Okay, so the fourth step is to evaluate the performance of the ETF itself. Okay, performance doesn't mean how much money you make or lose. Okay, of course that's important. Okay, but also I need to let you know, it is also how closely the ETF matches the index performance. This one is also important, apart from the overall performance itself of how much returns you get. Okay, so most index ETFs manage to track the investment results of an index, okay, and ETFs that fail to closely track their respective indices often reflect the difficulties of investing in the market, okay, such as the unavailability of certain securities or regulatory restrictions, including some that may be expensive or impossible to buy or sell. So any ETFs that do not fully replicate an index securities hold into a subset of securities designed to closely track the index. Okay, so a well-managed ETF minimizes both tracking error and tracking difference to deliver accurate index performance. So tracking index, of course, is like I said, is the difference between the ETF and its underlying index over a given period. Okay, it addresses how well the fund tracks the returns. So tracking error, okay, or the error it tracks the index itself, okay, it also plays an important part because it's it will reflect the volatility, okay, of how consistent their tracking quality is. Okay, so investors benefit from a lower tracking error if, let's say, the index tracks it closely, okay, because this tracking difference is actually gives the ETF a more predictable return. Okay, so tracking error can be caused by a wide range of factors. Okay, the first one is the difference between the holdings in the fund and those in the index rebalancing and transaction costs. So because of the how often the index rebalance itself and the cost it actually required to actually rebalance will cause these errors. Okay, to track the index closely. That's why I said always go for a lower cost ETF. So because you know it's lower cost, how often they actually rebalance the portfolio, you already know. Okay. And another part also the different tax treatments, because the tax also have will increase the cost of the income of the fund. So because of the cost is increased, the tracking error will be higher lah. Okay. So finally, step 5. Okay, evaluate the liquidity. Okay, you need to also understand the liquidity of an ETF. Okay, ETFs are easily tradable. Okay, even in you must know that you must make sure that the ETF, okay, is also tradable when in times of market stress. Okay, so the exchange tradability, okay, improves the liquidity, it enables investors to actually buy or sell ETF shares or with ease. Okay, hence liquidity actually need to fulfill 3 important criteria. So one is resilience. Okay, you must buy or sell the units easily even during crises lah. Okay, the next one is very easy to see. Okay, you need to take a look at the bid and ask can already. So the bid and ask must be actually efficient, means the bid and ask spreads will be tight, so that you can buy or sell your units easily. Okay, when you want to exit a position or enter a position during market crises. So as long as you see, even during market crises, the bid and ask spreads are tight enough. Okay, and of course, non-disruptive lah. Okay, trading of the ETF units does not affect the trading of the underlying assets in the ETF that it tracks. Okay. So therefore, the liquidity of an ETF is not limited to its on-stream liquidity only, okay, which is indicated through the ETF's bid and ask prices and the average daily trading volume. Okay, instead, we can think of the ETF liquidity as an iceberg with multiple layers of liquidity below the surface that are not always visible at first glance. So a lot of trading occurs in the secondary market itself, and it's no different than a stock. Okay, investors buy and sell ETFs in the market using common order types, and ETFs are quoted with bid and ask prices. However, the secondary market liquidity is only the tip of the iceberg. Okay, for example, if there are not enough ETF shares in the secondary market, which typically may be referred to as ETF inventory, the participants access the underlying market liquidity by purchasing the underlying securities and exchanging this for ETF shares in a process known as creation. These units can then be sold again in the secondary market. So overall, ETF liquidity is driven by multiple different components, with a large majority deriving from the liquidity of the ETF's underlying securities itself. Okay, so some of you might ask, why choose ETFs when you can also stock pick? Okay, there's no right or wrong answer to this. Okay, in a nutshell, the pros and cons of investing in ETF is that it provides you with instant diversification, okay, lowering your concentration risk, and it also requires lower effort. And it is a good way for busy individuals to invest and participate in the stock markets. However, what are the cons? Okay, the cons to ETF investing will be that you have to accept that you won't beat the market average in the long run because you are well diversified. Okay, and you are actually also at the hands of the fund manager itself. Okay, so the fund manager, when he invests a lot, and then there's also fund fees, okay, involved, of course, you will have to accept that you won't be able to beat the market average. Okay, okay. While the pros of the stock picking itself, okay, would be that you have total control of what stocks to buy and how many shares of the stock to buy and keep in your portfolio. All right. Being good at stock picking also allows you to possibly outperform the market average. But on the flip side of the risks are of course higher lah, and more effort is required as you need to manage the risk yourself. Okay, it all depends on your risk investment objectives and your risk appetite. Okay, based on my personal experience, stock picking itself requires more experience and effort in doing due diligence of an individual company. And even with the right amount of experience and effort, we might still get it wrong. Why? Okay, because we will not know everything about a particular company. And when we don't know everything about a particular company, there's an inherent risk that we might misjudge the value of the stock. Okay, and any misjudgment gone wrong could then lead into the worst case scenario, the company stop being suspended, and you risk losing all your investment capital, okay, due to the concentration risk. But for ETFs, okay, it's one company goes down, you still got many more that the fund manager actually invests in. So one company fails, you still got other. So your returns may not be that may not be the market, but again you can at least average out. So it's quite decent. So what for putting all the effort to stock pick yourself? So difficult, and then somehow you even if you understand the company that well, there's still inherent risk that the company may still go because you don't know everything. Okay, so again, most of us here have full-time jobs and families to take care of, and may not even have time to even master stock picking itself lah. Okay, therefore, the best alternative would be to diversify your capital in the most cost-efficient way. Okay, to still get decent average returns. Okay, to therefore invest in ETFs. Okay, so we let the full-time fund managers do their job in allocating our capital in the most cost-efficient way. So all you need to do, okay, just follow the 5 steps that I recommended you. Go to their website, okay, and you use them, okay, then you develop your own, okay, investment strategy to allocate your capital into ETFs consistently. Okay, I will now share my own strategy that I use. Okay, so apart on top of the 5-step framework to do due diligence on the ETF, okay, which is actually quite simple already compared to stock picking itself. Okay, the 5 simple steps to do the due diligence. What next? The next one is a strategy that you need, okay, to then invest in the ETF. So what strategy should we use, all right, to start to invest in the ETFs? Okay, before I start sharing, I want to let you know, okay, this strategy, okay, only apply to ETFs that you have a long-term horizon on, okay, and I believe that because you have a long-term horizon, this strategy will work for you the best. Okay, so I want to ask again, have you guys heard of this year approach to investing? Okay, come. So if those of you who have, please put a yes, and those of you who have not, please, put a no. Come, let us know. Wow. Oh, okay, no, good. Okay, any more? Great. Okay. Thanks, Vigesh. Thanks, Bing Yi. Thanks, Jacqueline. Thanks, Dr. Lee. Thanks, Chai Eng. Right. Okay. So good. Most of you don't know. Okay. So let me share with you now. Very interesting. It's a very simple method. You'll be surprised at how simple this is. Okay. So DCA is actually dollar cost investing. Okay. So dollar cost averaging. Sorry, dollar cost averaging. Okay. So it is an investment strategy where a fixed amount of money is invested at regular intervals. Okay, regardless of market conditions to average out the purchase price. So I believe many of you have done this before, like in the stock, okay, where the share price go down already, you buy more, so you double down, like catching a falling knife like that. Okay, but this is different, This is a bit different, I don't encourage you catching a falling knife, okay. By the way, all right. So let me share with you how I use this DCA method in ETF investing. All right, there are also 5 steps I use, okay, to identify a good way to do DCA. So this is not called catching a falling knife, but to do proper dollar cost averaging. But of course, like I said, the concept is similar to that. When the stock go lower, you just buy more. Stock go lower, you buy more. Something similar. Okay. So just to let you guys know the context first. Okay. So what are the 5 steps? Okay. The first one is, okay, these are 5 steps. Like I said, okay, the first one is to plan an investment horizon. So how do I do this? Okay, I first need to determine how long I will be investing for. Okay, am I prepared to buy the ETF for retirement? okay, you must ask yourself this, okay, if you are looking at buying the ETF so that one day you want to retire, okay, then good, okay, then DCA should be suitable for you already, okay, or are you just looking at 1 or 2 years, okay, then sell all after 1 or 2 years. Okay, my recommendation is always for this step one to plan the investment horizon is always to look at longer term. You look at longer term only, then this DCA will work. Short term one, then I don't think it will work for you. Okay. So for those of you who actually want to look at a longer term for retirement, DCA is the right way to go. The dollar cost averaging is the right way to go. Okay. The next step, what I do is after that, I plan the number of investment intervals. Okay, I then determine how many times a year I'll be putting money into the ETF. It could be quarterly, monthly, or yearly. Okay. Next one. Okay, I determine a budget. So how do I determine a budget? Okay, I set aside a certain amount, say $500 a month. Okay, after considering my monthly rainy day savings and expenses. Okay, so in this case, you must be actually very disciplined enough not to touch your investment savings so that you can let your investment grow. Okay, why is this important? Is a lot of times, many of you, I mean not you, okay, many of our new investors, new people who want to come into the investment game, uh, invest all their funds into the investment itself. All right, I used to do that myself. Okay, I'm a type of person where I think that I'll invest all, okay, save later, because I want to maximize what I want to maximize on the right time of the in the market, but there's no right time one. Okay, never think that there's a right time to time the market. You cannot time the market one. All right, okay. Just to let you know, you guys know, I'm actually a stock picker myself. All right, and until today, I cannot time the market itself. Even though I study the stocks, I spend so much time looking at individual companies, I still cannot time the company. I wouldn't know when is the low. Okay, so very important. Always do not invest all your money into the stock market itself, because at the end of the day, one day you know rest you need the money and the market is down. Okay, you cash out, you make huge losses. So always have enough savings, enough what you call it, disposable income, disposable savings for a rainy day. Okay, set aside this. Keep a comfortable sum into investments after all your other expenses. All right. Okay. I learned this the hard way. Okay, next one. The fourth one is identify the ETFs. So how to identify? Just now, we use the five-step framework that I shared with you. All right. So once you've gotten the first 2 steps, okay, number one is to plan the investment intervals, then determine the budget. Once you do that already, you know your objectives already. By then, you already narrow down to your objective. Then you use that to identify the ETFs, okay, by screening them. So I will then use just now the website that I sent you the tool to screen for the most suitable ETFs using the five-step framework. Okay. And then finally, capital allocation. Okay. For example, after I've identified 2 ETFs, okay, using the five-step framework, okay, to screen for the ETF one, I will now plan to allocate, let's say I got $500, all right, that I have set aside already for investing into the stock market. All right. I'll just set aside 500 and then I'll put in, maybe, for example, I think these 2 ETFs are equally as good. Okay. I'll just divide by 2. So I just 50 on this, 50 on this. Okay, for me, I will do it every individual month. All right. Because I want to track it more accurately. I want to track the market's average more accurately. I will be consistently doing it every month itself. So if you want me to actually share with you guys what's my frequency, okay, my frequency is every month. All right. So every month I will put in a fixed amount. I won't have a higher amount or lower amount. I always have a fixed amount, and then I will divide it across all my ETFs that I've actually screened for. Okay, so that's me lah. Okay, so in DCA investing, you do not need, the good thing about this, okay, dollar cost averaging, you do not need to bother whether the market goes up or down. All right, market up, you just go. Okay, market down, also go. Okay, so as you'll be putting in money diligently to the market, okay, in every interval that you've selected. Okay, no need to study charts or economic news, because it will average out eventually. Okay, accumulate your money into the ETF portfolio like a bank savings account, and you will see a sizable amount of money over time, of which your returns are compounded with the market average returns over time. If later I'll show you. Okay, the performance of all the indices over a 5-year time frame. Okay, you can see, take a look at the longer time frame. You'll be surprised. at what you see. Okay, so you may ask, how do you then actually buy ETFs? Okay, do you know that you can buy ETFs in Singapore? Okay, as SGX offer them too. Okay, some of them may be worried, some of you may be worried about investing in ETFs outside of Singapore because you will not be familiar with the foreign exchange rules and the taxes. Like just like I mentioned earlier, if you invest in the US, there's the 30% withholding tax. So good thing is Singapore also offers the ETFs that can track the US index also. Okay, so therefore a good place to start is to invest in Singapore, because the most striking benefit, okay, okay, in Singapore, not unlike the US, you don't have to pay any taxes on the dividends itself. Okay, for the US, 30% for Singaporeans. Okay, I will usually recommend the STI index and the S&P 500 ETF. Okay, they are listed in the Singapore Exchange, as both of these ETFs tend to be the most popular now. Okay, with most of my clients that actually ask recommendations. Okay, I will recommend these two because it's the most popular and easily tradable, very liquid. Because it's like I said, it's very popular in the Singapore context itself. Okay, so you can you can just save these two, screenshot these two, or take a photo of it. Okay, ES3 for the STI ETF, and S27 for the if you want to buy the S&P 500 ETF. All right. So one is for the Singapore ETF, one is for the US ETFs, both listed in Singapore, the SGX. Okay. But now you may ask, of these two, okay, which is better? Is investing in the STI better or investing in the S&P 500 better? Okay. So this is a question some of my clients will also ask, which is better. Okay. So now I will share with you which is better. Okay. So the STI index or the Straits Times index is widely recognized as the benchmark index for the Singapore stock market, in case you guys don't know. Okay, it tracks the performance of the top 30 largest and most liquid companies, known as blue chip companies, okay, listed in the Singapore Stock Exchange main board. Okay, here you can see that it has provided a total return of 62% in the last 5 years, and it currently pays a dividend yield of 3.9%. Okay, so you can see why the index generated 62% so far. You can take a look. Okay, since 2000, okay, earlier than 2022, you can see actually STX always traded sideways, right? All right, the returns actually came in right after 2024, 2024, 2025 onwards. You can see a huge pickup in terms of the returns itself. Why? Is because of course the banks have been doing well. The banks are the key components of the STI index. Okay, and because of that, and also US okay, the US has been doing well, so that's why the Singapore index actually picked up, and the overall return generated so far for the past 5 years is 62% if you invested 5 years ago. All right, so if I divided the total return by 5 years, okay, the 62%, okay, for the past 5 years, we actually get 12.4% return per year. 12.4%, not too bad, right? 12.4%, better than any bank return already. I mean, better than any fixed deposit already, or any Singapore government saving bond. Okay, for the past 5 years, you average it out, it's 12.4% per year. Okay, this is also excluding the dividends you receive. And bear in mind, these dividends that you receive, if you invested in the STI, is not taxed because it's listed in Singapore. Okay, so you don't get tax dividends for residents here, for Singapore residents investing in Singapore. All right. So while the S27, okay, the S&P 500, okay, which is a market index tracking the stock performance of the top 500 leading companies in the US, okay, has provided a total return of 85%. So you can see the difference now, 62 versus 85. Okay, and pays a dividend yield of 0.8%. So the dividend yield, of course, for the S&P 500 is lower compared to Singapore, because Singapore is always known to be a place where you can actually get higher dividends. So again, it depends on your objectives. All right, your investment objectives. Okay, so if I divided the total return by 5 years, okay, we get for the S&P 500, okay, 17% per year. All right, so if you invested in the S&P 500 US ETF, you would have gotten 17% per year for the past 5 years. All right, whereas like for the STI, 12%. All right, so 12% versus 17% per year. Okay, so why are the returns of the S&P 500 better than STI? Okay, of course, if you can look back again, okay, at the STI even further down the road, okay, STI has always been outperforming Singapore index one. Okay, because like I said, prior to the, like I said earlier, before the 2022 all the way until 2024, STI has always been trading sideways. Okay, but if you look at the US one, you see, it's consistently climbing up. Why is because the S&P 500 always have new companies actually joining the S&P 500, and because US has always been very innovative in terms of actually in tech, okay, and a lot of tech companies like the Magnificent Seven, okay, tend to be global well-known names, okay, and Singapore is lacks of that, okay, so Singapore is actually purely based on the banks itself that is driving the whole index itself. So that's why if you are intending to look at capital growth, okay, capital growth, the S&P 500 will be more suitable for you over time. So if you look at it, since the 1990s until now, you can see that the S&P 500 returns are compounded. It's much more stronger or greater than the STI itself. So STI mainly for dividends. If you are like a person that's, you want to feel safer in Singapore just to get the dividends, come to Singapore, buy the Singapore STI index. Okay. Try not to actually go to US and get, try to actually sieve out dividend investing through the US market, because it's not going to work due to the 30%. Of course, like I said, the 30% withholding tax. Okay. So gain purely depends on your objectives. All right. For me, I have been investing mostly on the S&P 500 ETF for my because I haven't retired yet. I want to actually generate more returns, more compounded returns over time. Okay, so that I can meet my retirement goals. Okay. So now I will show you a real case practical example, okay, of my portfolio returns. Okay, I created two portfolios to test out this DCA strategy. Okay, buying the S&P 500 index ETF, and the other is also to test my stock picking strategy. Okay, mainly I invested for my stock picking strategy. I invested in Singapore, US, Australia, and European stocks. Okay, over the last 3 years. Okay, so the last 3 years I've been diligently, okay, investing using DCA on the S&P 500 ETF. Okay, versus stock picking. Okay, I stock pick with myself as well, and I like to compare I use it specifically to compare which returns actually is better. Okay, stock picking or DCA. So this is a real life example because I asked just now which is actually better. So here, how many of you think that my ETF DCA strategy actually won the stock picking strategy? Okay, if you think that the DCA is a better method and I use it and I won the stock picking method, you can type a D. Okay, so those of you who think that stock picking is better, that I use stock picking and won the DCA method, type S. So for DCA, type D, stock picking, type S. Which one you think won? Wow. Thanks, Ming Chu. Thanks, Kim Soon. Thanks, Chai Eng. Thanks, Stephanie. Thanks so much for replying. All of you said DCA won. Okay, my stock picking. Okay, then let me show it to you. Okay, which one actually won? Okay, let's see. So this one will give you encouragement. Okay, if DCA actually won. Let's see. Okay, here you will see that. Okay, not too bad. Okay, when I started in 2023. Okay, uh, the S&P 500 actually was down small 0.21%, my DC using DCA. Okay, because during that time, okay, there was actually the S&P 500 actually took a hit. Okay, as the world was recovering from the COVID situation. Okay, most of stocks on the S&P actually fell from its highs, and the S&P continued to decline to its low of 3,500 points towards the end of the year. Okay, so if you notice that time if those of you who actually started investing in 2023, good for you, because during the time actually the S&P actually came down to as low as 3,500 points. You see today how many points? Okay, so you see returns is definitely there. Okay, for when you invested in the index itself. Okay, so because of that, I got a negative return in 2023. Okay, however, the markets recovered ever since, and you can see that by using the DCA method, my S&P 500 generated a 27% return in 2024. Okay, and 70%, in 2025. Okay, which is also very close to my stock performance because, okay, 2023, what I did was in my stock picking portfolio, why I did well in 2023 is because number one, I'm experienced. I take a lot of time to actually study stocks prior to the downturn of the market. Okay. And I already know what stocks to buy on. Okay. So I made money identifying undervalued stocks. I took a lot of time. I spent a lot of effort. Okay. That time was the best time also because the market was down so badly. Okay. I made money actually identifying undervalued stocks that are not in the market index itself. That is why. Okay. So most of the stocks that are in the S&P 500, of course, you will be able to track the index, but I purposely look for stocks that are not in the S&P 500 and at that point of time still doing well. Okay, but because the market is down, okay, investors don't have confidence, so they sold. When they sold, I buy. Okay, so that's why I did well in 2023. But however, ever since I have already sold all the stocks already. Okay, I've sold all those stocks. I made money through them. Okay, and I also bought some Magnificent Seven stocks cheap during the COVID period. Okay, so my performance in my stock picking portfolio have since closed the gap to the S&P 500 returns in 2024 itself. All right, you see 2024, the S&P actually did 37%, and I also did 27%. All right, despite putting in so much effort investing in the Magnificent Seven, because I no longer invested in shares that are not in the index, okay, because most of them are already fairly valued. So I mostly focus on the index stocks itself. And what happened? I get the same return as the index itself. So why put in so much effort when you can do it yourself? Like um, invest in the ETF without even needing to actually go looking into individual stocks, looking into the Magnificent Seven stocks. Let the portfolio manager do it for you. Okay. However, in the 2025, I just managed to beat by stock picking. I managed to beat the index just by 18%. Okay. This is just a 1.6% margin this year. Okay, this year the S&P 500 did not as well. Okay, 16.9%, almost 17%. All right, but I did around 18% because I bought the Magnificent Seven stocks really cheap. So that's why my portfolio actually did better in times of in times when the market is not, it is moving average. It's moving not, it's not driving it up fast like, because in 2024 I remembered the index, because the index came out from a low. So because it came out from a low, it drives up the returns quite a bit. So when the index actually doesn't move as fast up enough, because I invest in stocks in overseas as well. Okay, I have stocks in Europe, Australia, Singapore. So all these combined together, of course, some of them help me push my returns a little bit higher lah. Okay, so that's why when I calculated the average annual return, of course, yes, my average annual return did beat the market for the past 3 years on average on each year. 22% versus the return of 10% is because of the negative return and 2023 only. But imagine, because this is only 3 years, you cannot actually see much. Imagine investing over 10 years. I believe my returns okay will come back to the norms of DCA. So you guys are right. Okay, DCA actually would eventually, see, this is not conclusive because this is only 3 years. Because I have a negative return for my DCA in 2023 itself only. So that's why I always tell you guys, always go for the longer term. When you look at the longer term, 10 years, you don't have to do any homework itself in terms of understanding the market, understanding the company itself. No need to do all this. Just diligently invest in a relatively safe ETF. Okay. Over time, you will see that your average returns will just average out. In fact, 10%, 12%, 14%, good enough. You don't have to go and really try to beat the market. Okay. So with that, okay, I highly encourage you to start planning now, okay, using the frameworks that I have taught you today. Okay, hopefully you have learned something from this webinar. And with this, I shall open the floor to questions. All right, and do put your comments in the Q&A chat box, and I'll try my best to answer all of them. Okay, and of course, you also can share your experiences in terms of your investment journey. Okay, with using ETFs or stock picking. I'll try my best to share my experience with you guys. Okay, so like I said, this is an open community. We try to share with each other and learn from each other. All right. With that, thanks so much. And then there's a feedback form here. Hopefully, I get you guys to actually fill up the feedback form Okay, for me, if you enjoyed the topics that I shared and the value you can get from it. So hopefully in the future I can improve my
Hi, Joe.
topics and then my
Hi, Joe.
speech. Yes, hi.
Okay, so there's some questions in the Q&A and some questions in the chat that
Yes,
the participants are asking you. So
great.
while they do the feedback, can you help to answer some of the
Yeah, sure.
Q&As?
Yes, yes, definitely. All right. So while doing your feedback, okay, I will try to answer the questions from the Q&A. All right, let's start with the first. Let me take a look first. Hold on. Okay, wait. Let's see, is this all? Okay, let's start. All right, thanks guys. Thanks guys for putting up your questions. Okay. Okay, first one, Ming Chue Sid. Okay, Joe, what is long term these days? Okay, long term, okay, I would, to me, okay, at least for I would like to say, I don't know what's your age group, okay. For me in my 40s, all right, to me long term is actually when I retire. So that is long term. All right. Why? It's because I want to actually make my funds sit in the okay market. I don't want to time the market. I want to let it sit in there so that it can compound. Okay. Uh Year on year, so that I can maximize the returns of the market. So if I were to believe that, okay, let's say Singapore market, okay, if I were to believe that, for example, the banks will do well, all right, over time, in the next 10 to 20 years, why not? You know, why am I afraid of? Unless I feel that Singapore is not going to do well, okay. But if Singapore, I feel that over time, it will just be, the banks will just perform better and better. The economy will just become better and better because these things compound. All right, like you see your property prices, it's gone up over time, so much over time. So for me, I would say, okay, the time for me to actually sell is when I retire. When I say, okay, I no longer need what for I need so much money in putting in the stock market already. I don't need it anymore. I want to take all the money out just to put it in bonds, in something safer, okay, to retire. Okay, maybe by the time I reach 55, 60, time for me to actually use the money to travel. Okay, I will put in bonds. By the time I've already accumulated that 2 mil, okay, 2 mil, okay, I don't know how much, maybe you guys are richer than me, okay, 3 mil, 4 mil, into a relatively safe bond, 2%, 2%, okay. Some of you might say, okay, 2 million, good enough lah. I can just slowly just use it until I retire. That's why I said long term for me would be until the day I retire. So hopefully that answers your question, okay, with regards to long term. For you, maybe some, okay, long term maybe also 1-2 years. But again, like I said, 1-2 years, what do you want to do with the money? The next 1-2 years. If you sell it out already, okay, you've already started with the DCA framework, so much effort to diligently put money in every month. Then suddenly you say, okay, you need the money. Okay, maybe okay, you want to buy a house or buy something with immediate needs. Yes, okay, by all means, go ahead. But short term means okay, like 1 or 2 days, few months. That I'll be considering short term. So everybody's time frame will be different. Okay, for me, I said my time frame would be till I retire. So it's more than 5 years one. But for you, maybe 1-2 years, 3 years. It depends on when you need the money lah. All right. But most important, like I said, okay, to go for longer term, you will benefit you better if you use the DCA because you will compound over time. Okay, Warren Buffett actually shared this before. When you put in, your $1 in the S&P many years back, since the 1990s, how much would it have grown today? You take a look at it yourself, then you will realize the power of compounding, how powerful it is. Okay. Okay, thanks so much, Ming Xue. Okay, thanks for the question. Okay, Chai Hawk. Okay, the annual return is when you sell the ETF at the end of the year. Yes, correct. I have a cut-off time. So I always have a cut-off time of no, sorry. I don't sell. I don't sell. Sorry about that. I don't sell. Okay. What I do is I will always, if you're asking me, it's specifically about how do I calculate my returns. Okay, my returns is calculated based on I value my ETF investment when I put in my funds over time. Okay, so when I actually invested in during this every month, all right, I will see how much it grew. So it's the return between the start of the month, the start of the year until the end of the year. So I measure that way. So based on that, that is the return I calculate. So I don't sell. So I just based on my opening closing balance, opening, closing balance, opening, closing balance at the end of each year to calculate the return. So by then, your $1,000 that you invested in every month, $1,000 would have grown how many percent? You would be able to see lah. So do keep track of that. You can use your own. Of course, I think most brokers also have a P&L for you to actually keep track, so you can see your returns, your total returns over time. Then of course you can just divide it by how many, your total return. You can just divide it out. Then you can see what is your average returns. Okay, does the index ETF give dividend payout? Yes, it does. Okay, it does give dividend payout. But for Singapore, the dividend payout is higher lah. All right, compared to the US one that I shared earlier. So same thing like a stock, it will just pay the dividend into your when you buy the shares through your broker, the dividend will be just paid to you lah through the broker itself in cash. Okay. Oh, how about Ireland? Okay, Lim Johnny. Wow, good question. How about Ireland domicile ETF? I would not know. Sorry, Johnny. This one I need to actually check out because I am not a tax expert, like I mentioned. Okay, this one probably we need to I have to go online to take a look. Let me see if I can find it. Okay, but I'll try to answer other questions first. Okay, wait. Ireland tax domicile. This is actually better to actually speak to tax expert, but let me try to find, because most of them I wouldn't know your. Okay, this is also something I want to share. Okay, for taxes, okay, it does not mean okay, that if you are actually in Singapore, okay, a Singaporean citizen, you invest in the UK, that means you can get no, you don't, because some countries, if you are staying in like maybe UK or UK resident, sometimes you don't get tax at all for ETF that is listed in the UK itself. Okay, just giving you an example. But if you're Singaporean investing there, because you don't have the tax duties and things like that, it may be different. So that's why I cannot be certain. If let's say I can find out for you the Island domicile tax ETF, what is the taxes like? I wouldn't be able to actually accurately advise you. So this one you need to probably need to speak to a tax expert lah. All right, because it depends on where you stay. Okay, some tax efficiencies may be for US citizens, not Singaporean citizens, because you think that okay, the Ireland domicile ETF, you see online that is actually has good tax benefits, but because you're Singaporean, maybe you cannot get it. So I hope that you can check it out. Okay, I can't see any online also lah when I'm looking at it now. Okay. So hopefully, I mean, do check it out with a tax expert lah. So sorry about this, Johnny. I would love to actually advise you on this, but I wouldn't be able to accurately do it. Okay, so I will try not to actually confuse things. Try to find out with a tax expert. Okay. Thanks so much, Jacqueline. Thanks so much, Anne. Yes, thank you for joining as well. That's why it's great for you guys to join. But stay on, okay, to listen to the questions asked. And if you guys have any questions as well, please share. Okay, for Adi Hidayat, for S&Ps, why not invest in units instead of SGX counter? Yeah, correct. So for S&P, what you're investing in already is already in units already. Okay, so ETFs are actually not in shares okay. So just to clarify, if you invest in ETFs, it's not shares. You invest in ETFs, it's mostly actually units. In units. Okay. So you go to SGX itself, you invest in the STI ETF. One unit, two unit you buy, it's not shares. They don't go by shares. You can buy in ones. Okay. Just for example, if in case you guys didn't know, okay. For the S&P 500 and the STI itself in the Singapore Exchange, you can buy one share, one unit, two unit, three units. But for others, like you want to buy the SGX counters, like UOB, OCBC, all this you need to buy 100. Okay, UOB, OCBC, all these banks, all these are shares. The shares you have to buy in minimum of 100 size lots. They call it lots. Okay, but for ETFs, they go by units. You're right. Okay, Adi, great. Okay, you got that right. Okay, invest in the S&P is actually units already. So when you buy the ETF, S&P 500 ETF, it's already in units. Okay, Chai Hong. Okay, can ETF give me regular passive income? Yes. Okay, is REIT ETF better than index ETF? Okay, REIT ETF, to me, what I saw before, because Singapore has this REIT ETF as well, if I'm not wrong. I remember it pays also 3%. Then of course I would prefer the index ETF lah, because index ETFs are much broader. Okay, and you can participate in the, because REIT ETF alone, okay, this is my personal opinion only. REIT ETF, to be honest, okay, REITs itself are lesser, they don't gain as much, okay, in terms of their capital gains, all right, compared to, of course, like you said, if you've seen the banks in Singapore, it's gone up so much already. Okay, so if I want to participate in the best of both worlds, okay, because if you invest in a REIT ETF, they also average out in terms of the dividend yield. So the last time I checked the REIT ETF in Singapore, one particular REIT ETF in Singapore, I forgot the name, okay, sorry, forgive me for that. It also pays about 3%, high 3% in terms of dividend yield. Then the S&P, the SDI ETF also, just I showed you, it also pays about 3%. So I rather participate in the index ETF because of the capital gain potential. Okay, if you invest in a REIT ETF, yes, you can get 3% passive income. But if you see that your capital gains is not growing at all, because capital gains is also very important. Okay, that's why I said you must invest in the right ETF. Okay, no point the ETF pay you a good dividend, but the capital gain keep on coming down, keep on making losses on the ETF. No point. Okay, you're wasting your time in the ETF only. All right. So why not go to an index ETF where you can get the best of both worlds, 3% plus. Okay, currently okay, not saying that historically it pays 3%. Currently it pays 3% dividend yield. Plus take advantage of the capital gains, because you don't know which bank to invest in. For example, you don't invest in UOB, you don't invest in OCBC, you don't invest in DBS because you're not sure. All right, go for everything, because the STI, for example, the STI ETF invests in all these top companies in Singapore, and because the banks also pays good dividend yields, okay, you can get it through the ETF as well at 3%, so you can participate best of both worlds. Okay, for the REIT ETF, is it physical or not? Okay, I already forgot which REIT ETF that I saw. There's one in Singapore. Okay, let me see. Let me see if I can find it. Okay, there's one in Singapore, but you have to check it out yourself whether this ETF is actually physical or replicated one. Okay, Singapore. Wait, let me check it out. Thanks, guys, for holding on. Singapore REIT ETF. Okay, there are many lah. Okay, there's the Lion Philippe S-REIT ETF, which you can also take a look at. All right. This particular one also actually invest in the of course Singapore S-REIT represents Singapore REIT lah. Okay, the stock code is CLR. Okay, China, London, Russia. You can just take a look at that. Okay, there are quite a few more. Okay, you can see which ones actually suit you best, because every REIT, like I said again, every REIT has its own objectives. So you need to take a look which REIT, which objective you would like to actually suits you. Suits you. Okay. So for the S-REIT itself, okay, you need to see whether they invest in blue chip REITs or not. Okay, there's some ETFs that don't invest in blue chip REITs. They invest in Singapore REITs that look for high yield returns overseas one, because there are also a lot of lot of REITs that invest in China but list in Singapore. Okay, so this type of REITs okay, they usually pay high dividend yield. Yes, true. Okay, but the fund's objective is to actually use this type of REITs to try to get a higher yield. Okay, but the danger is, okay, because it's invest in the structure goes into like countries that you're not sure of in terms of their asset quality, the real estate there, whether safe or not. Okay, but because they lure you in with high yields, this REIT so happens to invest in them. When the market tanks, the REIT also will tank. The ETF also will tank. Okay, so bear in mind this. Okay, so if you want to go for a REIT ETF, please look at the objectives again. Okay, make sure that you invest in the blue chip sort of REITs. Okay, REITs that invest mainly in Singapore one. Okay, for these ETFs. Crypto investment. I'm sure. Okay, unfortunately for Boyans, we don't offer crypto investment, but there are crypto REITs, crypto ETFs. Sorry, I thought about REITs until I'm confused. Okay, crypto ETFs available, but this is mostly listed in the US, because US is more, easygoing in terms of crypto investment. You can invest in crypto REITs, crypto ETFs as well. All right, but bear in mind, okay, any ETFs that invest in crypto also, you must make sure that they are not leveraged. Okay, you must make sure you understand their structure before investing in them, because you will not know what these funds do, how they invest in these cryptos. Okay, do they actually borrow money to invest in the crypto? Because crypto is also very volatile, as you guys know. And what sort of crypto they invest in? All right. Always, like I said, at the end of the day, go back to my 5 framework structure. Make sure you understand your objectives well first before doing your due diligence. Okay, even before doing your due diligence, you need to understand your objective well. Then only start doing your due diligence using the five step framework. Okay. Oh, great. How to start an ETF account? This is a good question, all right? Okay, I said earlier, you can sign up an account with us. All right. I can probably put up the link here if you guys already filled up. Okay, hold on. I go back to the first page, so that you can forgive me, guys. Okay. I go back to the first page. You can sign up for an account here. So once you sign up for an account already, very easy. Once you open an account, you fund your account. Okay. Once you fund your account, okay, sorry, I'm in share. Okay, wait, hold on. Sorry, if I'm speaking too fast. Thanks for actually highlighting. Hold on. Yes, okay. So all you need to do is actually just fund an account. Open an account through using this QR code. Okay. Hopefully you can hear me now. I'll try to speak slower. And then you can open this account, fund your account, and then go through the screener. Okay, when you actually open that account already, type in your account number, password, and then after that, start looking at ETFs itself. You can use the screener to screen, and then when you find an ETF that you like, okay, type in the stock code, the ETF code, and then just click buy. Simple as that. Then you can start buying an ETF already. All right. But okay, very important is you need to actually do a quiz as well. You need to be experienced in investing in ETFs. So once you open an account, a dealer will get to you. One of my teammates will get to you and also probably guide you lah. Okay. In terms of actually, you can send an email in. You can see my email there. You can send me an email. Okay. I can guide you myself as well of how you can actually sign up for this account and then use it to fund it and trade ETFs. But firstly, you need to fill up declaration that you understand what the ETFs are. So that one also I will have to guide you guys. Okay, for those of you who haven't have experience trading ETFs and then want to open an account with us to start trading. All right. Okay, Ming Che, okay. Is there a crypto ETF that we can buy via Philip? You can look through at the screener that I sent you guys. Okay, and then use it to you can search by the objectives or the themes, okay, the type of ETFs that we provide. You can see whether there's a crypto ETF or not. So sorry, I wouldn't be able to, because there's so many ETFs going around. I wouldn't know whether there's a crypto ETF or not. But you can find it as long as I think it's traded in the exchange of the US stock exchange. We'll be able to actually buy it through Philip lah, buy it through us. Okay. Kim Soon, how to short an ETF? You don't have to short an ETF specifically. Okay. What you can do is actually you can just look for a reverse ETF. Okay. Go to that screener again and look for a reverse ETF. Use that screener to find anything that to do with reverse. Okay. Reverse something like maybe reverse index ETF. Those are actually ETFs that short the index itself. Anything that says reverse means shorting. So you just click buy. Okay. The price of such short ETFs or such reverse ETFs will go up when the market comes down. When the index comes down, the prices of these ETFs will go up because it's a short, it's a ETF that actually short the market one. Okay, so you can take a look at that. But bear in mind, these ETFs are actually also most of the time replicated ETFs. They are not actually physical. Okay, they are replicated ones because they will use derivatives to do the shorting. Okay. Or of course, yes, you also can use CFDs. Okay, CFDs is another way to short an ETF as well, or an index ETF. You can use that as well. All right. So CFDs is another thing which I wouldn't be able to share with you guys in detail. So you can open an account, and if you want to find out more, you can speak to my team regarding this through the email that I shared with you guys in this screen. Okay. Okay, Bing Yi, cost plus account versus cash managed account. No, it's not cost plus, it's cash plus. Okay. Yes, good question. Cash plus actually offers lower commissions. So if you are focusing on going into the US market, and would like to actually trade frequently, okay, do go for the cash plus. Okay, so cash plus will be more viable, but bear in mind it's actually a marginable account lah. So most important is you need to manage this account well, because if you fund in a certain amount of funds and then you do not you overuse. Let's say you put in 1,000, you because we give you some leverage to use. I mean some credit. Okay, you overuse your funds and then you go into credit, then interest will kick in. Okay, interest cost will kick in. So bear in mind about this account that is a margin account. Okay, so very important. Cash Plus, it's good. It's a good account because it's a low cost, low commission. Okay, but there's a margin facility. So be very careful that if you want to use margin, do it diligently lah. Okay. Okay, can share a few potential index ETF for your reference. Okay. I'm okay. Thanks, Chai Hok, for this question. For the ETFs itself, if let's say you want to look in the US, okay, Singapore, like I shared already earlier, this only these two ETFs that good index ETFs, popular index ETFs listed in Singapore Exchange. I highly encourage you to do that, okay, because if you are not familiar with the US, try to use the index ETFs, okay, the Singapore listed index ETFs to trade, okay, to invest in. But if you like to look at it further, okay, in the US, okay, I can share with you. Try to look at the VOO. Okay, VOO is a very good S&P 500 index to look at. So you can just type the letters V, okay, V for Valentine, then OO, okay, VOO, because this is a very cost-effective ETF, S&P 500 ETF. Okay, it's 0.03% only, if I'm not wrong, the expense ratio. So it's very low compared to the SPDR. Okay, the SPDR also tracks the S&P 500. That one has a higher expense ratio, because the expense ratio to me, it's very important. So I would highly recommend you to take a look at the expense ratio itself. So VOO is a good one. Okay, it's quite popular as well for people who actually want to invest in the S&P 500, because it's known for its low cost lah, the Vanguard. Okay, VOO. So take a look at that. Okay, on top of the other two that I shared. You also please also look at these two lah, the Singapore ones first. It'll be good for you lah before going to the US one. Okay. Okay, thanks, Shai for that question. Okay, Kim Sun, what is CFD? Okay, CFD is basically it's a derivative. Okay, so what it does is actually it actually it invests. Okay, it actually is a derivative that actually looks at the difference in terms of share in terms of pricing. Okay, your stock prices. So what it does is this CFD that you invest in, okay, you have to put a certain amount of money in. Okay, this I'm just sharing with you a brief overview lah. Okay, what CFD is. It's actually quite a lot of things to share. You can probably email me, and probably we can have a chat over the phone lah. You can email me to that email above, and I probably can chat with you over the phone in detail what CFDs actually are. But in just a short brief explanation is, it's actually the difference between share prices of a certain stock itself. So you actually, this is actually a product that's actually market made by Philip itself. All right. So this product goes by you are actually betting on the difference between a particular stock or particular security. All right. So it's not actually investing in the security, the stock itself. So you don't hold, let's say you buy a CFD in UOB, you don't actually hold UOB itself. You don't hold the shares of the of UOB itself. So it's highly leveraged. Okay. What clients who invest in CFD do is they will actually fund in a small amount of money. Okay. This is called an initial margin, okay, or deposit. So you fund in the initial margin of a certain amount, say 30%, okay, and then you can take up to a certain amount of you can hold up to a certain amount of positions in a particular stock. All right. So by putting maybe $800, you can hold up to $10,000 worth of UOB, something like that. All right. So it's highly leveraged, and we also charge interest when you hold it daily. All right. When you hold the CFD instrument daily, interest is also charged lah. Okay. But if you'd like to know more, you can actually send us an email, and I can explain it to you further. All right. Thanks, Kim Sun. Okay, Chai Hao, is Lion Philip ETF? Lion Philip ETF. Sorry, I can't really get what is Lion. Okay, Lion Philip actually has several products lah. Okay, But like just what I shared with you, the REIT one, that one is an ETF itself. All right. Sorry, Ming Chair. Okay, please repeat which ETFs can give 3% and also enjoy capital gain. Oh, okay. Ming Chair, good question. Okay, the ETF that can actually give 3% enjoy capital gain is the STI. What I'm sharing is the STI. Okay. But I cannot be sure that STI can continue giving huge capital gains since the 2024. Because like I said earlier, the STI itself, the Singapore Straits Times Index, gone up quite a bit because of the banks going up, the bank share price going up. Because the STI actually, the STI component, the Singapore Straits Times Index components, majority comes from the banks itself. All right. So I cannot guarantee you that eventually over time, the capital gains will continue on being this much as what I shared earlier. Okay. But which ETF can give 3% and enjoy capital gain, both dividend yield and enjoy also capital gains, is the Straits Times Index. Okay. So do look at the STI ETF. This one can give you 3% and also enjoy capital gains. Okay. Okay, Beng E. Okay, it seems that markets will be coming soon. Should we avoid 2003 negative by holding cash instead for 2024? Sorry, Beng E, I can't really understand what you mean by this. That markets will be coming down, is it? So if you say that, okay, just like to okay, I mean, I try to give an explanation. I'll try to share my explanation as much as I could for your question, okay, because I really can't really understand this. But if you're asking me whether the markets will be coming down anytime soon, okay, if you're worried that 2026 will be a potential down bear market, okay, bear market means a market that is coming down. For now, I don't think so, okay, because as of today, I think the US is also announcing another the Federal Reserve in the US is announcing another rate cut. So with a rate cut, I believe that the index can go up high. Of course, over time it will correct, okay? Because of any negative news or Donald Trump say something, okay? The market can still come down, of course. But for now, do I see a huge crisis going to happen? No lah. Okay. So holding cash, not too wise lah. If let's say you should hold cash now or not, I don't think it's wise to really hold cash and wait, because you cannot time the market. You cannot wait until the market really come down then start buying, because you will never know when the market will come down. Even if it comes down, soft landing, should you go in or not? So every time you say that, okay, the market, because people will keep on thinking that the market is too high. Then when the market come down a bit, they still think it's too high. So you never know whether you shouldn't time the market lah. Okay. So the best way to do it is DCA lah, like I shared with you earlier. Keep on going in consistently month on month. Okay. Every month go in a certain amount of money. So you don't need to worry whether the market up or down lah. All right. Yes, correct. Yes, you're right, Chai Hawk. Okay, it's Lion Philip S REIT managed by Poem. Philip, it's not by Poem, it's by Philip. Okay, Philip and Lion. Okay, they join together to manage this REIT. You're right. All right, it's managed by Philip, not Poems. Poems is actually just a platform, a trading platform. Okay. Okay, Kim Soon, I've already have a margin account. Can I use this account to trade the ETF just like trading for shares? Kim Soon, you already have a margin account with us. Okay. Yes, you can. Definitely. You can start actually using the account to trade ETF already. Just go search for ETFs. Go under the ETF tab, then search for the ETFs that you like. Okay. Sorry. Okay. My QR code is not opening. So sorry for that. Okay. Just go to the link. Okay. Go to the link and that we put in the chat. Okay, to open an account. Okay. You can see the link there. Just use that link if you want to open an account. Okay. EC, is the replays for this session available later? Unfortunately, I wouldn't. There will be no replace on this. Okay. But we do have a YouTube channel. Okay, which I will share the excerpts from this webinar. Okay, if you really did enjoy it, I encourage you to join the next one. Okay, easy. But again, okay, we do have a YouTube channel. We can put a YouTube channel here as well. If my teammate can do it for me. This YouTube channel, do subscribe to it. all right, it will have the excerpts of the what we shared today. All right, that means a short summary lah. Okay, so but I encourage you to come to the next one. Okay, of course you can write into request as well, but okay, I said okay, highly encourage you to come join the next one. Okay, what's the Singapore Index ETF? What are the Singapore Index ETFs? Okay, like I shared with you just now the check out. Okay, the Singapore Index ETF is so far only this one that I've actually wait Singapore. I give you the stock code again. Okay, wait I have to find it from here. Okay, I'll show it to you again. Yeah, here. Okay, ES3. This is the only index ETF, STI ETF that is for the Singapore indices. All right, you can just start ES3. All right, this is the one that actually invests that the fund invests in the STI index itself, that tracks the index, the ETF, the STI ETF, the STI index. Sorry about that. Okay. 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 GPL. Okay. Just now I mentioned the VO ETF. Okay. When you search in the internet, why does it seem not to show the dividend yield? Okay, wait. Why does it seem to show that the dividend yield is only 1.15%, which is quite low? Yes. Okay, VOO actually this ETF invest in the US S&P 500. So for US S&P 500, as I shared earlier in my webinar, this ETF itself pays low dividends. Okay, you cannot get high dividend yields from the US market. The one that actually pays a better dividend yield is the SDI. Okay, so do take a look at the SDI ETF if you want to actually have a higher dividend yield. Of course, the VOO, because it invests in S&P 500, it only gives you the lower dividend yield. So very important, you need to understand your objectives. Like I said again, okay, go back to your framework, understand the five-step framework, and if you actually identify them already, what is your objectives, then choose the ETF that most suits you. Some of you may want to have actually a better capital return one. Then the VOO will be suitable for you. All right. Okay. Make sure again. Okay. Double check. Even if you're doing DCA, you could also enjoy. Yes, of course. You can also enjoy dividends because you invest in the units over time. The units pay dividends itself. So over time, you will just get the dividends. Okay. No, the dividends are not paid monthly. So they will usually declare dividends. Okay, you need to take a look again at their website, which months they declare the dividends. Okay, you can actually find it out from the screener itself. Okay, and you see whether it shows you or not. Or of course, you can also go if you're not sure where to find it in the screener, then go to the fund's website itself, or you can just type in Google. Okay, for example, STI ETF dividend payment history. Okay, you search for that, all will come out already. The months it pays. Okay, you just find out and you just take a look at the historical periods that they pay the dividends. Take note of that, and then in the future you will know already when they pay the dividends. Yeah, okay. So there are many types of ETFs that track many types of funds that track the STI. Again, you need to understand which fund, what type of fund structure they use, and very important, the cost. Okay, the cost also plays a big part again. So there can be AMOVA, many others. All right. Of course, I still go for the popular ones. The fund, like I say again. Okay, just now I shared with you guys the structure. Okay, the structure plays a big part also. So liquidity, for example, does MOA STI ETF have liquidity? Okay, because the spread play a part. Okay, I'm very confident that the STI ETF, the ES3 that I shared with you just now from the SPDR. Okay, this STI ETF ES3 is managed by SPDR. Okay, these ones because they are big. Okay, these fund houses are big enough. Okay, they have huge AUM, so definitely the spreads are tight. Okay, the cost is lower, okay, compared to any others lah. So I highly recommend you to still look at the ones that are popular lah. But okay, I mean, I will strongly encourage you to go and do research on the Amova STI ETF as well and compare and see which actually suits your requirements more lah, right? Okay, Beng Yi, you have a cash plus account with Philly Capital, so I just fund and invest. Okay, you just fund and invest first, all right? And then let us know again, okay, once you have actually opened an account and funded, okay, then I can actually help check, my teammates can actually help check whether you've actually qualified after. Okay, you have, of course, you have to fund in first and then put the money in for the like based on the T&Cs. Okay, so once you've done that already, let us know again. Then I can check with the relevant team, okay, to see the eligibility. Okay, but once you actually follow the requirements based on the T&Cs, right? Okay, automatically you will be able to receive the rewards lah. Okay, so it's automatic. Okay, you don't have to actually join the promotion. You just have to fund in whatever you have based on the T&Cs, and then it should be there already. Thanks, Bengi. All right, thanks you guys. Thanks all. Okay, for the good questions. All right, I hope to see you guys again. Okay, have a good evening, guys, and see you guys again. Thank you, Child. Thank you, Bengi, for all the good questions. Bye bye. Good night.